Hi there everyone, we're going to have a look today at bringing our evaluation for monetary policy really bang up to date, all the way up into 2022. This is going to be quite a detailed look at some of the best evaluative points that you could make. And looking around, there's a lot of resources, your textbook and other revision videos that have a lot of generic evaluation for monetary policy. We're going to look at today how we can really include the most relevant and context-based points that really capture the debates going on at the moment in the UK. So right now, UK monetary policy is all about the debate of whether and how much to increase interest rates, responding to rising inflation that has been caused by rising energy prices. The debate is about contractionary policy. This is what has changed quite a lot. If you go back looking at monetary policy 5 years ago, in the middle of 2016, the Bank of England voting there to reduce interest rates using expansionary policy. Well, now it's about policy going in the other direction. And if you look at the last Monetary Policy Committee meeting, the actual split in the vote was not about whether to put interest rates up or down. It was about how much to increase interest rates by. So you really need to update the evaluation that you're picking. Here are 5 classic areas for evaluating interest rates. And we're going to talk about some of those ones on the left-hand side there that are the most relevant and topical issues to talk about, rather than some of those ones on the right-hand side which are completely correct in theory, but are not that relevant to the monetary policy debates going on today in the UK. So let's talk about trade-offs first of all. And in particular, the major trade-off that the Bank of England is considering at the moment is the trade-off between inflation and growth, particularly short-run growth. Now, of course, there's also relevant trade-offs between inflation and unemployment, but the nature of the UK labour market at the moment is that unemployment is quite low. And while the Bank of England are expecting it to perhaps increase slightly over the next few years, that is not the motivating reason at the moment to think about wanting to keep interest rates low. It's about growth instead. So really this leaves monetary policy makers in the UK at the moment with 2 alternatives. One option is to increase interest rates, and that will, yes, help bring the inflation rate back down and closer to target, but the cost there is going to be that you're going to harm short-run economic growth. And of course, as you go into the exam, you're going to want the most up-to-date figures there to use for the inflation rate and short-run economic growth figures in the UK, the quarter-on-quarter or year-on-year growth rate. Now, the other alternative for monetary policy makers is they keep interest rates low. Like I say, the debate really at the moment is not too many people saying we need to bring down interest rates. It's whether we keep them lower than we otherwise would do. And that would help support growth, but at the cost of higher inflation. And a great extra contextual evaluative point to make there is the idea that higher inflation could start to bring a wage price spiral, where rising prices start to lead to higher wage demands from workers, which then in turn increase costs for firms and leads to further increases in inflation. And this is where some of the slightly kind of naive, misguided comments came some criticism from the governor of the Bank of England about wage restraint. That was really his motivator there, as he wants to try and ensure that this process doesn't happen. So you can only achieve one of those things. That's an important limitation to monetary policy, that it can't achieve both of those important objectives for the UK economy right now. Likewise as well, it's very important to recognise that monetary policy is relatively limited in what it can actually achieve to do with the underlying causes of inflation at the moment. That at the moment it's about increasing gas prices, and that's increased the cost of production, disruption to supply chains as well, the short and aggregate supply curve across the economy shifting to the left. And you should really think about monetary policy in the UK as being something that shifts around the aggregate demand curve, not the short and aggregate supply curve. Now these are actual real shocks, right? This is actual real stuff happening in the world. And so interest rates are limited in what they can achieve this. Of course, you can have an effect on inflation and growth, but you can't undo the cause of the problem. Now, it's worth perhaps contrasting monetary policy with this with fiscal policy, because fiscal policy does have more capacity, and you might want to read up about some of the proposals about what the UK government right now could be doing in response to rising energy bills. Things like reducing VAT on energy bills would be a great potential policy there to contrast with what monetary policy can achieve. Right, let's talk time lags. Very, very popular piece of evaluation here to use when referring to monetary policy, but you've got to make sure at the moment you use it in the right kind of way. So typical time lag, we're expecting you change interest rates today, and then you expect the peak impact, the maximum impact on inflation then to come somewhere between a year and 2 years away, depending on which academic you believe. But either way, everyone acknowledges there will be a lag between the decision you make now and the peak impact on inflation. Now, why that's really important right now is it's possibly the case that these rising gas prices will only be a short-term event, that market forwards curves are anticipating that gas prices perhaps start coming down towards the end of this year. Well, in which case then you're making an impact on inflation in 12 to 14 months time, when the inflation's only really going to be around for perhaps the next year. And then you've got to consider, okay, if I'm setting interest rates now for 2 years' time, you've got to not be thinking about what's happening right now, but what's happening by the time that they're having their peak impact. Perhaps by then, with gas prices coming back down, there aren't inflationary pressures. Perhaps then other negative effects on growth at the moment in the UK start to take over, and you'd be in a situation where you wish you'd actually had lower interest rates now to carry on supporting growth in 2 years' time. You need to be careful with this point, because it's a great point for evaluating monetary policy as its own policy, but be careful with comparing it to other policies. Because if you take, for example, fiscal policy, the main alternative way of stimulating short-run growth in the UK, well, yes, that might have a more immediate impact when it's decided, but the political nature of fiscal policy means that it's always going to be a less flexible, less nimble instrument for dealing with macroeconomic problems in the short run in the UK. So always be very careful about saying, okay, a problem with monetary policy is the time lag if you're comparing it to other policies. So, okay, let's talk about our important but perhaps less relevant evaluation and why it's less relevant right now. I used to really love the evaluative point around the zero lower bound on monetary policy, that when you're using the main tool of monetary policy, which is interest rates, that you can't reduce those interest rates below zero. And the idea that then you end up with this kind of liquidity trap where interest rates can't get low enough to encourage low confidence consumers to spend their excess savings. But the reason why this is not the most relevant right now, as we said, at the moment, the debate in monetary policy in the UK is about contractionary policy. The zero lower bound only applies when you're reducing interest rates. It's about how low you can reduce them. There's no upper bound on interest rates. Sure, there might be reasons not to increase them to do with some of those trade-offs that we spoke about earlier, but there's not the same kind of firm limit with increasing interest rates that there is with reducing them. So great, really, really important point, tremendously important 5 to 10 years ago, less significant to the debate around interest rates in the UK right now. Likewise, unorthodox policy. So here we're talking about quantitative easing, funding for lending and forward guidance are the most common ones there in A-level specifications. You might have also heard about other concepts like helicopter money, where you print money and give it directly to households to stimulate spending. But this has the same problem the zero lower bound point does. This is an alternative method of expansionary policy, when, as we said, the debate right now in the UK is about contractionary policy. And these unorthodox approaches, the reason why they were invented as these kind of alternative approaches to interest rate policy is because interest rates hit that zero lower bound and hit that firm limit to which extent they could be used. So there's no need to explore this unorthodox policy if you're looking to use monetary policy to reduce growth, reduce aggregate demand and control inflation. So they're not that relevant to that current debate. So overall, what are the points that I think you should be making when you're evaluating monetary policy, February 2022 and up into the summer? Well, I think you should be thinking about the trade-offs between inflation and growth, and particularly they're recognising how growth and employment are in a slightly different situation in the UK is a really powerful one. That you can recognise how it's limited in what it can achieve, and again there we talked about a contrast with fiscal policy there could be very, very effective. And then this issue of time lags, not as this kind of generic textbook point of, oh, monetary policy has a time lag, so maybe it's not that good, but particularly raising for right now, if it's a temporary issue affecting the UK, that should be taken into consideration when the central bank makes their decision around interest rates. I've included in the description of the video, if you look below, a link to a few other extra useful articles that you could read. There's a Ben Broadbent speech where he talks about the importance of time lags and trade-offs to UK monetary policy. He's the Deputy Governor of the Bank of England. Leading UK macroeconomic academic Simon Wren-Lewis wrote a blog post where he was very keen to put forward the point that at the moment in the UK we should not be so quick to increase interest rates right now. And the ever excellent Chris Giles has a great article in the FT very clearly laying out the motivating ideas for the Bank of England and their contractionary policy right now.